Let's get to my educational segment, which is about separation. Okay, what does that mean? We've seen sectors, right? When we get good news on the coronavirus, like we're seeing now, right? Today, we're going to see cruises go higher, travel stocks go high, all these stocks that are impacted the most by COVID. Those sectors are going to go higher when we have positive news, right? Just like they're negatively impacted as this takes longer and longer, where they got hit the past couple of weeks as more places were deciding to close down and we're seeing cases spread. But an interesting trend is taking place. Look at the banking industry, right? Goldman came out today, reported record quarterly net revenue in their investment banking business, including record quarterly net revenue for both equity and debt underwriting. This is something, if you're a subscriber to my services, you should be very familiar with, that this is going to happen. Why? Because Goldman is not leveraged to the consumer like traditional banks. They're leveraged to the stock market. They're leveraged to volatility. In other words, the more volatile the market is, the better their systems work, which basically front run the market, which you all know. They don't care about what stock they're buying or who's running that company. They're able to see all the orders in the market and act a million times faster than everybody else. Again, it's an amazing story. I can't believe the SEC is okay with this, but hey, that's fine. That's okay. That's okay. Anyway, they're leveraged to SPACs, which are the new vehicle where, the new IPOs. Just Google that. You'll know what I mean. Special purpose acquisition companies. They just set up on the exchange as a public entity, and it's a holding company where it could be 30 million, 100 million, 50 million, whatever. And then they'll go out and buy a private company, and immediately they don't have to worry about the costs and going through the whole IPO process, and they become a publicly traded entity. DraftKings, looking at several of these. Nikola was another one. I mean, a lot of you're looking at the biggest hedge fund managers, and now you have the biggest investment banks are getting into SPACs. Again, everything that they're looking at, you're looking at IPOs. I mean, how good have IPOs have been launched been doing? You see that market starting to take mergers and acquisitions. We're seeing that, right? Lots of mergers and acquisitions. These are all monster growth markets where the Fed's injecting trillions into our economy, and trillions more is coming. That's going to benefit Goldman, but it's not going to benefit Wells Fargo, where the numbers were horrible. We'll be cutting their dividend. His CEO Charlie Schwartz said, demand growth has largely stalled. It was growing at a nice clip through June. He says the virus, unfortunately, was also growing. And if you listen to some of the banks, even JP Morgan, Jamie Dimon said, thank God for the government and stimulus spending, because he's seen the trends out there. These guys see the trends of consumers, and it's not pretty. It's not pretty. You're looking at airlines. Delta, fantastic quarter considering the market conditions. Cash burn is under $10 billion a year and has close to $16 billion in liquidity. That's what you want to see. Why? Because the virus, I say in 12 months, we will have a vaccine. And that means Delta's going to survive. I can't say the same for American Airlines. Also $15 billion liquidity, but much higher cash burn. Other smaller airlines, Southwest is in pretty good shape. You're looking at American still raising money, so they likely need to lay off 20,000 plus employees. Look at rent-a-car companies. Hertz, bankrupt. That's great news for Avis. Avis is going to take huge market share. You say, well, Hertz, file for bankruptcy. Again, they're under those bankruptcy laws. They're allowed to operate, but still, it's going to be a different business, right? They're going to have the newest technology, the newest cars. They're cutting costs. They're going to have as many people working for them. It's going to, hurt their brand. You're going to see a difference. Avis was smart. They cut costs a lot sooner than Hertz, and they're going to take huge market share. They have liquidity. They're going to dominate this industry, which rental cars is a monster industry. Just got saturated with so many companies, right? Now you saw consolidation and Avis and Hertz buying up a lot of these names. Well, we recommended Avis in our Curzio Venture Opportunity newsletter late May. If you're a Curzio Venture Opportunity subscriber, don't get mad because you're up 35% in just a few months. But if we get a vaccine in 9 to 12 months, this stock is going to more than double. The names that are going to survive, think of the dot-com era. The companies that went bankrupt, the companies that survived. There's a reason why technology companies have the best balance sheets in the world, because they lived through that moment and came close to going bankrupt. But if you go through that process and you get smart as a company, you become lean, you know what to do when the next crisis comes, what you need to cut. It's an amazing learning experience if you can get through this. Avis is through it. Hertz didn't make it. Cruises, casinos, travel-related stocks. Guys, this is what I want you to do during earnings season. Pay close attention, not just to the sectors, but individual names. They're going to be reporting earnings over the next few weeks. Pay close attention to liquidity. Because when you look at these sectors, they've largely gone up or down over the past few months based on the status of the coronavirus. And going forward, assume that's going to be here in 12 months before we get a vaccine. So it's going to be about earnings, sales, liquidity, which earnings didn't matter now. But sales, liquidity is very, very important because you're going to see profits come down incredibly. You're going to see sales come down incredibly while we're closing more places for some of these businesses. And not all these companies will survive within these industries. And the ones that do are going to see incredible growth over the next 3 to 5 years. That's where you want to position yourself right now. So be sure. Don't just say, hey, the cruise lines look good. No. Look at Carnival. Look at Royal Caribbean. Look at all of them. See which ones, look at their liquidity, and make sure they have enough liquidity to last over the next 12 months. Because when we get a vaccine, these are the names that are going to soar. And the ones that don't have enough liquidity, they're going to have to raise money and dilute the hell out of shareholders. If you go to debt, raise money through the debt markets and pay an insane amount of interest. But if this thing lasts longer, those are the companies that may not survive. And when this business starts booming, why is it going to boom? Because the Fed is spending trillions right now, 30% of GDP to fuel this economy, which is insane. And more money is coming, which means we're only going to have to operate pretty much at 40% this year in order for GDP to really, and our markets to actually grow, because the Fed is just, and all the policies and the stimulus is insane right now, but that's going to fuel the companies that make it through this over the next 3 to 5 years. You want to be invested in those names. You don't just want to buy sectors or ETFs. Start looking at individual names. That's what we've been doing for our newsletters, and we've been nailing it in both, at least for me, for Curzio Venture Opportunities and also Curzio Research Advisory.